This video is about financial significance of supply management, and we will discuss three financial metrics: profit leverage effect, return on assets, and inventory turnover effect. The first one is profit leverage effect. The idea of profit leverage effect is that if supply managers could reduce material cost a little bit, that can bring significant increases in profits. So for instance, in this case, here is revenue, that's $1 million. Material cost is $440,000 and labor cost is $200,000. But if a supply manager is able to reduce that material cost by 15%, which means we multiply 440,000 by 0.85 or 85%, the new material cost will become $374,000. This reduction in material cost changes the profit from $160,000 to $226,000, and that represents an increase of 41.25%. Here is Excel data. So the material cost is 440,000, and if we reduce this material cost by 15%, which means the new material cost will become 85%. So multiplied by 0.85, new material cost becomes 374,000, and that also increases profit from 160,000 to 226,000. And now we want to see how much increase has happened, and that would be the difference, the current one minus previous divided by this one, and that is 41.25%. This shows that by reducing material cost by 15%, the firm could increase their profitability by 41.25%. The next financial metric is return on assets, also called as return on investment, which is about how efficiently management is using its total assets to generate profit. The formula for return on asset is this one: net income divided by total assets. Now, an organization has different types of assets. It has fixed assets. Some examples of fixed assets include property, plant, and equipment. That's also called as PPE. And then there are also current assets, which include cash, accounts receivable, short-term investment, and prepaid expenses. But in the context of operations and supply chain management, the most important type of current asset is inventory, which comprises raw material, work in progress, and finished goods. So as you can see in this formula, net income is numerator and total assets is the denominator. Now, if we want to increase return on assets, we have two options. One option is that we increase our net income, or the other option is that we reduce the denominator. And in denominator, there can be different options. In the context of inventory management, if an organization could reduce its inventory, which means if they could reduce this denominator, still keeping the numerator same, that would increase return on assets. When a firm has high value of return on asset, it means that organization can generate large profits with relatively small investment. So a high value of return on assets mean that a healthy organization. The third financial metric is inventory turnover, which means how frequently inventory is utilized or replaced over a particular accounting period, such as a year. If inventory turnover is low, it would mean inventory is sitting on the shelves for a longer period of time. Maybe there is poor sales or there is overstocking. That's not a good thing. However, on the other hand, if inventory turnover ratio is high, it means inventory is not sitting on the shelves for a longer period of time and organization is using that inventory to create more value and more revenue making opportunities. The formula for inventory turnover ratio is cost of goods sold divided by average inventory. If we are using this at a monthly level, then we'll be dividing cost of goods per month divided by average monthly inventory. If we want to calculate it at the annual level, then we'll be using mean of 12 months. Cost of goods sold includes direct material, direct labor, manufacturing overhead, inventory cost, freight and shipping, and customer duties and import taxes. This is the data to calculate inventory turnover ratio. As you can see here, this row is about name of months, and this is ending inventory for each month. So 80,000 is the inventory for January, 60,000 is the inventory for February, and then this is cost of goods sold. So this 225,000 is the cost of goods sold for January. This is for February. Now, in order to calculate inventory turnover ratio, we will first calculate average monthly inventory. So average monthly inventory is the average of ending inventory of January and February. Now I can copy the same formula to other cells. So as you can see here, if I double click on that, it shows us that the ending inventory of January and February has been used. For March, it should be ending inventory of February and March. For the month of January, we will use ending inventory of January and the ending inventory of December last year, which is here. So that will be average of inventory of December last year and of January. Then the next thing is calculating monthly inventory turnover, and monthly inventory turnover is simply the ratio of cost of goods sold and average monthly inventory. So if we take the ratio of 225,000 and this inventory level, that will give us monthly inventory turnover ratio. So that's equal to 225,000 divided by 62,500. So that gives us 3.6. And I can copy the same formula to other cells to calculate average monthly inventory turnover for other periods. And here we get, it says that monthly inventory turnover for January it's 3.6, for February it's 4.64. And again, as you can see, the formula is very simple. It's a ratio of cost of goods sold and average monthly inventory. Then the next thing is annual cost of goods sold. So here we have cost of goods sold, and we will take the sum of this one. And then average inventory for the year. So for this average inventory, we will take average of all these 12 months. So we have this monthly inventory. If we take their average, that will give us average inventory for the year. So average inventory for the year turns out to be 62,917, which is the average of inventory of 12 months. Annual inventory turnover ratio is the ratio of annual cost of goods sold and annual inventory for the year. So we will just take the ratio of these two, 2.971 million divided by average inventory for the year, and that becomes 47.22.